Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can also follow me on Twitter and talk to me on Patreon. Okay, let's just have a quick review of the Q3 earnings and we can get into things in more depth over the coming week. I just thought I'd go over some of the highlights and my initial thoughts and reactions. We have automotive revenue at $12,057 million. Now I had this at $12.2 billion, which I have to say was pretty close. As we can see, regulatory credits are starting to come down now. I had them at 300 million and they were only 279. As we know, this is not a dependable part of the company and has acted as a great bonus in the meantime. But Tesla came out with a 30.5% automotive gross margin. I was only at 29.3%, but I did say I wouldn't be surprised if they were over 30%. Well, I did say that, but to be honest, I'm still surprised, or at least highly impressed. 30.5% is absolutely insane. And this is before we have Texas and Berlin operational. Can you imagine what gross margin Tesla can obtain then? This was due to China ramping up so much, likely as a result of using the lower cost LFP batteries in the Model Y standard range. And on top of that, the Model S sales increasing and using LFP batteries in the Fremont Model 3 as well. These margins will continue to rise in Q4. But if we remove regulatory credits, then that's an automotive gross margin of 28.8%. How outstanding is that? Oh, and let's not forget something here. Tesla aren't using their own batteries yet, the most expensive element of an electric vehicle. It's been reported that Tesla pays $142 per kilowatt hour for batteries, presumably for 2170 batteries. The Model Y long range has a 75 kilowatt hour battery, which would cost approximately $10,000. If the 4680 batteries are only half the cost, that's $5,000 saving per vehicle, or about 10% of the price. In other words, that takes 30% margin to 40%. Just with the battery, not to mention front die-cast molds, etc. Seriously, I almost feel like I'll be ridiculed for assuming such progress. Okay, granted, this will be just for the new factories, but it won't be long until they contribute to about 3/4 of vehicles produced anyway. In other words, within time, the vast majority of vehicles could have 40% margin. 40% margin on a car, the highest priced capital item people buy after a house. But within time, this could even be improved on, with Tesla's vertical integration and as efficiencies further grow, so who knows how much higher they could get. And on top of that, Tesla don't need to reduce their prices, because the demand is getting stronger and stronger. For energy revenue, I managed to get that about right, at 801 million compared to 806, although services and other was a little lower than I expected, and down over $50 million from the previous quarter. Energy did scrape a small gross profit, and services is approaching break-even. But in addition to that, we have this new Megapack factory coming online, and it looks like the capacity for this factory has been shown in the earnings report, and it appears that we'll have a capacity of 40 gigawatt hours. To give you some reference, Tesla only deployed 3 gigawatt hours in the last 12 months. In other words, this is some serious ramping up. I think this is also partly due to CATL ramping up their LFP battery production so much too. In other words, there are enough batteries for energy that they don't have the opportunity cost of going into vehicles. Yes, we can't wait for this side of the business to start growing too. Remember, Tesla isn't just a car company. R&D is up slightly from the previous quarter, and selling general admin up a tiny bit too. But these costs are not really increasing anything relative to the automotive revenue. So the more the revenue increases, the higher the net profit margin will become over time through economies of scale. Restructuring was $51 million. This is a loss in Bitcoin, which I had at $48 million, which I have to say was very close calculation as it's not easy to judge. This came in to a net income of $1.6 billion, up from $1.1 billion last quarter, which is outstanding. Obviously, if we annualize that number, it gives us $6.4 billion earnings. By the way, the current market cap is $857 billion. If we use that annualized earnings figure of 6.4, then that's a PE ratio of 135. 135. Tesla is still a bargain if you ask me. Don't forget, we're going to see something like a 6-fold capacity over the next few years, and these gross margins on autos could reach 40%. Yes, it's a growth company, but it's not like typical tech companies and how they grow. The EV industry takes a very long time to grow, and the exponentials take a long time to kick in, because it's an incredibly intensive manufacturing industry, which also means it takes that much longer for the competition to catch up. We're still only at the start of the S-curve. Over the next few years, we're actually going to start seeing much bigger numbers. Just think about 5 million vehicles being sold and a higher profit margin. Well, if the net profit margin is 50% higher than today, in that scenario, then there'd be over $48 billion in earnings, which would be the equivalent of a PE ratio of 18 at today's stock price. You know, if we didn't include FSD, robotaxis, energy, or any other future this company has. This is just solely from the EV retail business. And that's when Tesla sell 5 million vehicles. We could be approaching 10 million a year around 2025. I can't wait to generate models on all this. There is a reason Tesla is worth more than all the legacy companies combined. Just like at one time, there was a reason when Ford was worth more than all the horse and buggy companies combined. This is what disruption looks like. And the stock price is behaving exactly how I suggested. It would run up before the report and the call, and then drop after. I said investors would then consolidate, and we would expect it to break $900 over the next couple of weeks. So let's see if that happens. We can go over the report in more detail over time, so let's discuss the earnings call. Tesla plan on exceeding the historic levels of S and X. The demand for these vehicles must be very strong, despite such high price points. These vehicles are great for profit. The highest they were in the past was around 15,000 units each a quarter. I said in a recent video I expect them to reach 20,000 each, which aligns with what was said on the earnings call. In Q2, we were told that the Model S line was actually at a loss, because they only produced so few models, it wasn't enough to cover costs. That was not the case in this quarter, but the more they ramp up these models, the better the margins will get, especially when they add Model X as well. The thing is, we're about to see something similar on Texas and Berlin, and we were told on the call that margins will be down as a result. The new factories will likely be running at a loss to start with. So just a warning for Q1, or possibly even a little bit of Q4, but we were told it's not likely we will see deliveries from the new factory this year either. We were kind of told when the compact model will be released, and this was in line with what I have been saying. Tesla are limited by batteries, so there's no point bringing out new models when Tesla can't make enough of the current models to meet demand, especially when the new model we're talking about is a much lower cost vehicle, and thus carries much less profit. I think Tesla will be closer to 4 million units a year until they release the new compact vehicle. In other words, probably closer to 2024. That is good for investors, as it means we will have a higher average selling price for now. Right, average selling price. That was down 6% from 2020 Q3. Tesla says this is due to the shift towards affordable vehicles, of which they can only mean they reintroduced the Model Y standard range. And yes, Tesla were selling more Model S and X's back then too, but only 5,000 more, and the average selling price of an S was a lot less than a Plaid. Anyway, in my opinion, it's plainly obvious that a standard range Model Y will come out in Texas and Berlin soon enough too. But it does sound like Texas Model Ys might come with the 4680 batteries early next year. We were told that structural battery crash, range and reliability testing are on track to be complete this quarter. Testing to date has gone well. It's a new architecture and there may still be some unknown unknowns. As a lot of you know, I think the 4680 batteries are a crucial element to Tesla's success. Any sign of the fact that they will happen soon is huge to me. Just if they can happen makes so much difference. As I said before, we could see at least $5,000 reduction in cost. It could be even more though, which adds majorly to the bottom line. $5,000 extra profit for every car, and at 2 million cars a year is an additional $10 billion on EBITDA. A lot was spoken about insurance. It sounds like some insurance premiums were still reasonably expensive for Teslas, and Tesla are trying to reduce the cost of ownership of Teslas with vertical integration like insurance. It just makes the car more affordable again. Of course, doing it in a Tesla way, you're also adding to profit too. Tesla insurance is going to be great for customers, but I think its main advantage will be to increase demand, as it's generally not going to have a huge impact on overall earnings. In fact, I actually believe the main reason Tesla do insurance is because I don't think any other insurance company will consider insuring a robotaxi. Tesla have so much data already, they're able to analyse the characteristics of a driver that is more likely to be involved in a collision, hence these safety scores. The data Tesla collect is just invaluable. I think we'll go over this in more depth sometime. I felt like the questions were quite good this round, some people asking some great questions about capacities of the new factories, but the answers were a little coy and we didn't get any new information, just that they expect to reach between 5 to 10,000 units a week. Same for growth, of where they'll be in 2024, the same answer we hear, 50% growth. Except that of course, we will see more like 100% growth next year. Nothing mentioned about Tesla's in-house LFP batteries. That's unfortunate no one brought that up. It's really such an important product. It will likely be the batteries used for the compact Tesla as well. So again, no point launching the compact model until this battery production is ramped up. To summarise, demand has never been better. In fact, it's better than even Tesla thought it was going to be. Margins are going to continue to improve, or at least once the new factories are ramped up. And production will increase. And that's just the auto business. Remember, this has been a really difficult time to be in manufacturing with so many supply chain issues. which is especially hard for automotive manufacturers. Imagine once things get easier again. Anyway, all in all, everything sounds good, and I'm really looking forward to seeing how Q4 goes. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.